Hey everyone, Chandra Boucher from the Venture Analyst, and everyone is talking about defense stocks right now, and they should be. Global military spending just hit around $2.7 trillion, a record. The US is proposing 1.5 trillion defense budget. NATO committed every single one of its 32 members to 5% of GDP, Canada just met actually, and the run war is driving oil above $100. Governments are buying weapons they haven't purchased in decades. So this narrative is actually pretty airtight, and the spending is real. And yet, I'm not buying the US defense stocks right now. Not a single one. And in the next 10 minutes, I'm going to explain to you exactly why, and most importantly, where I actually think the money is. Let's move on. So before I get into why I'm not buying, let me be clear about something. I'm not here to tell you that the defense spending boom is fake. It's not. These numbers are verified. They're current and they're accelerating. Global military spending is at 2.7 trillion in 2024 and the 10th consecutive year growth, the biggest single year increase since 1988. NATO has a new 5% GDP spending commitment across all 32 members. Trump is proposing a 1.5 trillion defense budget for 2027, which is the largest in history. So the macro is legitimate. The spending is real, so the question is, why am I not buying the stock? There's actually three reasons, and they stack up on top of each other. Let's move on. So look at this chart. This is the 2025 performance for the major US defense names. We have GE Aerospace, which is up 87% in a single year. RTX, Raytheon's parent company, it is up 60%. ITA, which is the main US aerospace and defense ETF, which is already up 55% compared to the ETF, which is up only 18%. Right, so now you see that the stocks are already kind of pricing all of this in. So let's move on to the next section. So the forward PE on the US defense sector right now is above 22x. You're paying a 22 times multiple to price to earnings. The S&P 500 historical average is 18.9x. The defense sector, which is most of its history traded at a discount to the market because of the slower growth and government contract risk, is now trading at actual premium to the index. So look at the individual names. We have RTX is at a 27x forward earnings. General Dynamics around 23x. Even Lockheed, the cheapest of the primes, are at 17x. X is in multiple, by the way. This carries a political risk premium, and I'll explain in a second. So think about what you're buying here, what you're paying for. You're paying for growth stock multiples for businesses that have historically grown at a mid-single digit. This depending on Congress for revenue and are not being told by administration that certain capital return programs are restricted. That's not really a cheap setup. Which brings me to my problem 3, which is one that I think is genuinely underappreciated. So the government wants more spending, but they're actually threatening the stocks. This is the most defense stock coverage is not talking about, and it's genuinely strange to me. Trump wants to massively increase defense spending. The numbers are real, and I've already covered them. But in January 2026, he also issued a consecutive order that prohibited defense companies from paying dividends and doing stock buybacks unless they want to invest more in manufacturing capacity. And he actually personally called out RTX on Truth Social. He said, I'm not quoting directly, but Raytheon seems to think this is the Biden administration, and it's not. He threatened to stop doing business with them entirely if they didn't change how they're allocating capital. The Pentagon then launched what they're calling an extended review period for all major defense contractors. The defense secretary publicly attacked executive salaries, buybacks, CEO pay at companies that can't deliver on time. So think about what this means for you as an investor. You're buying the stock partially for their dividends. Lockheed has raised its dividend for 22 consecutive years. RTX is a dividend aristocrat, and these are income investor stocks. The administration is strictly threatening these programs. More spending, yes, but the government's threatening the capital return mechanisms that made these stocks attractive in the first place. And that's not a simple trade. So, in my opinion, the cleaner play here is the continental weight. While all of this was happening in the US, the European defense spending boom was running faster than none of its political noise. Here's the context. Russia invaded Ukraine 4 years ago. Europe woke up to the fact that it had been outsourcing its defense to the United States for decades, and now the US under Trump is signaling it's not going to be the world security guarantor anymore. So Europe is doing something that hasn't done since Cold War. It's rearming at a scale. Look at this chart. EU defense spending went from 240 billion in 2022 to an estimated 360 billion in 2025. That's a 50% increase in 3 years. Germany passed the 500 billion defense modernization package. Poland is spending 4.5% of their GDP. The Baltic states are building fortifications along their borders. The European Defense Index was up over 65% in 2025. Some individual names more than doubled. Rheinmetall, Germany's largest defense company, is up over 540% in 3 years. And here's the key difference. European defense companies are not dealing with Trump's executive orders. Their governments are their customers. Their dividend programs are not being threatened. The spending is committed to multi-year, no political interference from Washington. Let's move on. So here's the European names I think are worth knowing. So we have one that I mentioned, Rheinmetall specifically. This because the name tells you the whole European story pretty much. 9.9 billion in revenue in 2025, up 29% year over year. They're guiding to 45% sales growth in 2026. It's a record order. They have a record order backlog of 63.8 billion euros. That's over 6 years of revenue at current run rates. Locked in contracts from governments that have signed the dotted line. Now, is Rheinmetall cheap? No, it's about a 39 multiple forward earnings. After 440% run, nothing is cheap. But the spending cycle is real, multi-year and without the used capital noise overlaid on top. Also worth watching, we have BAE in the BAE Systems in the UK. This is Europeans' name with the most reasonable valuation relative to this backlog. They won a 10 billion pound Norwegian frigate contract, won a $1.7 billion US Space Force contract, and they're up 21% year to date in 2026. Sweden's Saab has also been the most spectacular mover, up nearly 200% a year, and it's also the most extended. Let's move on. So here are the TSX names nobody's covering, and let me tell you why they matter. Now here's where this gets specifically interesting for us as Canadian investors, because the same spending wave that's happening in European defense names also directly benefit Canadian companies on the TSX, and most retail investors have never heard of them before. So we have CAE. This is Canada's largest public defense contractor. They don't make weapons, they build military flight simulators, and here's why that matters. Every country is buying a new fighter jet, and dozens of NATO members are buying F-35s, Typhoons, Gryphons right now, and every one of them needs a pilot. Every pilot needs thousands of hours of simulation training before they touch a real aircraft. CAE makes these simulators. Their defense revenue grew 13.6% in its most recent quarter. Their defense backlog sits at $11.2 billion. They have $6.1 billion more in the pipelines pending customer decision. The government of Canada just named the strategic partner of the Royal Canadian Air Force's Next Generation Pilot Training Program. They're quite literally at the center of Canada's defense spending increase. Another name we have over here is McGillian Aerospace. Their ticker on the TSX is MAL. It's the quieter, smaller name. They make the components that go inside the military aircrafts and engines. Aero engine parts, rocket motors, satellite equipment. They're in the F-35 supply chain. They make Canada's black brand sounding rockets. And they're up 52% in the past year. Most retail investors have never heard of them. These are real Canadian companies on TSX, directly tied to the global rearmament cycle and the Rheinmetall and BAE systems, but without attention. So this is where I land. The defense spending cycle is real and it's multi-year. I'm not arguing against that, but what I'm arguing is that the obvious US names, Lockheed, RTX, Northrop, they're already priced in on all the good news. They carry political risk and are hard to model, and you're buying after 60 to 90% run. That's not where I would want to put my money. The more interesting plays are the names that benefit from the same spending wave but without the US political noise. European companies in earlier stages of the re-rating, and specifically these two Canadian names on the TSX, they're directly in the path of the cycle but barely have been covered. So for the full breakdown, the valuation models on CAE Morgulid, the DCF scenarios, whether European names like Rheinmetall have the room for current prices, run room for current prices, and exactly how its size position in space. That's where the premium deep dive is dropping alongside all the video. The link will be in the description. If you're already a TVA Premium subscriber, you've got it. If you're not, this is a good time to check it out. Every initiation report, every sector breakdown, every future release, all in one. I'm Jonathan, this is the Venture Analyst, and I'll see you in the next one.